Hello, everyone. We're going to get going here in just a minute. I've got a couple people who are going to be logging on here shortly, and we'll get going. Today is sort of our introductory cash balance plans, how they work, how we structure them. Want to make sure everybody's aware that on the right-hand side, there actually is a chat where you can pose questions. Certainly, as I'm going through the slides, feel free to type in any questions that you've got. I'll try to answer them as I go. If not, I'll cover them in the end. This usually takes 20, 25 minutes, and we'll give 5-10 minutes for some questions. I also, if you're interested in the slides at all, there is a handout section here on the right, and there is a download there, so you can download the slides as you see fit. So let's just give it another minute or so here, or 30 seconds, and we will get going. All right, so I think we're set. Let's dive in. So like I said, today is the intro on cash balance plans. Just trying to give everybody an idea of how to structure these plans and how to use them to make most efficient tax and retirement decisions here as we go into the end of the year. Excuse me. Today, the overview. We'll do a quick intro. I'll tell you a little bit about myself and the company. We'll also discuss what a cash balance plan actually is, discuss the pros and cons. The cons are most important. The pros are very self-explanatory, so I do want to make sure I always discuss the downsides to these plans. We'll also talk about who's a good candidate, review strategies that we use, and we also come up with a special topic each time. We're going to talk a little bit about a cash balance plan illustration, talk a little bit about kind of what an illustration would look like. And then we'll also do, like I said, a Q&A. Certainly you're welcome to pose any questions that you can, that you come up with as we go through this, okay? First of all, I'm a licensed CPA, 30 years of experience. Started structuring these plans about 10 to 15 years or so ago with many of my clients. That's all we do. Obviously, I do a lot of my specialties: retirement structuring, comprehensive tax planning, entity structuring. I do get involved in a variety of creative tax structures from time to time. If you're in a unique situation, certainly you can reach out to me, and there's other things that we get involved with from time to time. But mostly at Empyrean, we do retirement structuring, cash balance plans, defined benefit plans. We do third-party administration and compliance, but we do not do financial management. We are not financial advisors, and we don't do tax returns. But what we try to do, our main goal is to advise clients on how these plans work, and also work a lot with CPAs and financial advisors so we can advise them on how they can structure these plans to make sure that they work for their clients. It's no surprise, probably 90% of CPAs and financial advisors don't really understand these plans. So we work a lot with a lot of those folks to help structure them. We also, obviously, our goal is to lower, clients' tax bills and help them grow their retirement. So talking a little bit about what a cash balance plan is. Most people have heard of a 401k and a SEP. We'll talk a little bit about some of those differences, but a cash balance plan is actually an IRS approved qualified plan. So, it falls in the same categories as those other plans in that they're qualified plans for tax deductions. Every dollar you put in it represents a current tax deduction for you. They are a type of defined benefit plan. So in this webinar, I typically will use cash balance plan and defined benefit plan interchangeably. Many people come to us and say, hey, I want a cash balance plan. Some people, I want a defined benefit plan. We use those words interchangeably. There are some unique differences, but for all intents and purposes, for most people, it doesn't really matter. I would say think of them as one of the same. They're going to give you very similar contribution levels. These plans are actuarially determined, and our actuary does review them annually. With any plan that you have, our actuary is going to sign off on what we call a Schedule SB and the SB will actually essentially approve and is filed with the IRS for a group plan, and actually is us essentially certifying and signing off that you've made the mandatory minimum contribution, at least to the plans. And these plans are typically good for any contributions over $100,000. If you want to get in 20, 30, 40 grand, your best bet is to stick with a SEP or a 401k. When that's not going to move the needle for you, you want to move up into, a different type of plan, like a cash balance plan or defined benefit plan. So typically our average client, we ran a study a while back, was getting in around 150 grand a year. So if that, a tax deduction of that size makes sense, the cash balance plan can make a lot of sense for you in the structure. We'll talk briefly about the difference between a defined benefit plan and a defined contribution plan. So as we discussed, a defined benefit plan, or excuse me, a defined contribution plan, I'll start off with that, like a 401k or a SEP. There is a defined amount that you can put in up front. There's a limit that you can establish up front. Once you've contributed to that limit, it doesn't matter where your assets go up or down, because the limits are established up front. But with a defined benefit plan, it works in reverse. We can get in up to $3.1 million into a plan for you. And that is the benefit, the maximum benefit we can get. So because the limits are so large on the back end, we can get much larger contributions in there. That's why our typical contributions are $150,000, is 150 grand is going to be the typical contribution that we get in. So, the defined benefit plan, though, does take into consideration your asset balances. So that's why you want to keep these things a little bit more conservatively invested. And that's why an actuary has to sign off on these upfront. So again, really, they're different types of structures. They work very differently, but in many structures, many of our plan structures, we do combine a defined benefit plan with a cash balance plan, a defined benefit plan with a 401k, which is going to allow you to maximize the benefits of both of those types of plans. Okay. So again, a little bit different on how they're structured. One defines a benefit at retirement, and you make contributions towards that goal. Your asset balances are very important. Defined contribution plans, you're just putting in a contribution based on the current year. Whether your money goes up or down is generally irrelevant to the calculation. Why do people set up cash balance plans? Number one reason, tax deferral. We can get contributions in as high as 300 grand. In fact, we can do some prior service and some very interesting things. So we can get, annual contributions, 3, 4, 500,000 for an individual, depending on age and income, typically for someone who's much older and a very high income. Easy way for business owners to catch up on retirement. They also can be rolled very easily over into an IRA. So your typical exit strategy is going to be to make these contributions while you have the earnings and the capabilities to do so. Once you get to a point where you don't need the plan anymore, you can terminate and roll it over into an IRA. You also can contribute up to the date you file your tax return, with the latest date being September 15th. Most of our clients are S corporations, and so these plans will work very well for them with that funding date of September 15th. And also, just something to note, these are traditional large pension plans. And you would see them in very large businesses, but you can set these plans up for sole proprietors. We'll have, sole proprietors that make a couple $100,000 a year set up these plans. It might not be the ideal situation, but absolutely is possible. So if you want those large tax deferrals and you want to get a lot into retirement, start building that tax deferral, these plans can make a lot of sense for you. Pros and cons. I think we've covered the pros for the most part. Ability to combine with a 401k, ability to make very large contributions. The goal is to roll it over into an IRA or even a 401k at some point down the road. But they also allow for very good flexible funding. Sometimes people think, well, I'm locked in at 100 grand a year or 200 grand. We could do that, but we generally don't. We're generally going to try and find out what your range is. So if you want to do 100,000 a year, we're going to try to structure a plan maybe where you can do 75 to 200. So you can take a little bit off the table if you need to. You also can add some on or fund at a much higher level if you feel like you've got the added cash flow. The cons are very important to go over. Remember, they're much more expensive to maintain. We can talk a little bit about pricing, but generally speaking, we set up a solo plan for $1,000 to $1,500, but you're going to pay at least a good $2,000 a year. Our solo plans will start at $2,100 a year, for annual administration. So they do cost you a little bit more. That's always a downside. That's why if you just want to get 5, 10, 20 grand into a plan, you definitely want to stick with something a little bit cheaper like a SEP or a solo 401k. These plans are permanent, which means that the IRS assumes that they're going to be open for at least several years. They've not defined what several years is, but needless to say, go into this with a long-term intent. Expect this to be something you're going to contribute for, 3+ years. Our average client will have them usually around 7 years or so. Go into them with some permanent intent. You also are going to have to make some mandatory contributions to these plans. So you want to make sure you've got adequate funding for the next few years. If you've got a very volatile income where maybe this year you're going to make 400 grand, next year maybe 50, might not be the best fit for you. So you got to just kind of weigh it to see if that makes sense. And obviously they're a little bit more complex to explain, hence this webinar. And again, a little bit more challenging to administer. So make sure you consider the cons, the downsides to these plans before you set one up. Moving along, best candidates, companies with consistent profits, professional service businesses. Probably 60% of our plans are with physicians, a lot of attorneys, CPAs, a lot of IT professionals as well. Also great for people looking to catch up on retirement savings, people looking to maximize tax deductions. And also they can be used as sort of a type of a bonus structure almost. They're great for clients who are looking to improve client morale and retain employees. They can work very well in some of those situations, certainly. We're going to talk about a few specific funding examples or illustrations. We'll talk a little bit about kind of an illustration on a kind of topic that we like to do. We like to cover sort of a special topic. But in this one, we've got an illustration or example. We've got 3 of them here. We've got a 35-year-old IT consultant, 58-year-old physician, 65-year-old attorney, both different ages, slightly different income with different funding levels. So the goal here is to kind of illustrate this isn't necessarily maximum levels or minimum. These are just kind of giving you examples of some plans we've set up here in the last year or so, just to kind of give you an idea of what you can do with these plans. First example, 35-year-old consultant, and these are all going to be S corporation illustrations. The compensation is $200,000 and the business profit is $150,000. So the total income in the illustration for the IT consultant would be $350,000. Now they can do a 401k deferral of $20,500, still allowed to do that. They also can do a profit sharing contribution, but that profit sharing is actually limited from a traditional 25% down to 6%. So that's going to be $12,000 there. In this example, they've got $98,000 in on the cash balance plan contribution. Total contribution of $130,000, and with an average tax bracket of about 40%, they're able to save about 52% on their taxes in year 1. Moving on to the 58-year-old illustration, same compensation, $200,000, business profit a little bit higher, $400,000 on the S corp with a total income of $600,000. They can do the deferral of $27,000. That is the deferral for someone over 50. Profit sharing is going to be the same as the prior illustration. It's going to be 6% of the W-2. So that's going to be about $12,000. The cash balance plan, because these plans are very much age and income driven, that allows them to get a 58-year-old to get a lot more in. So $212,000. The total contribution here to retirement plans is $251,000, and the tax savings here just over $100,000. So you can see, based on the comparing the 2 illustrations, The IT consultant and the physician had the same amount of income, but the physician is able to get a lot more in because of the age-driven calculations. Again, the older you are and the higher the income, the better off. Now, the last illustration here is going to be it's going to be for a 65-year-old. In this example, this happens a couple times a year where we get an illustration where someone has won a settlement of some sort and they want to get a very large contribution in. In this example, they've got a settlement. Their income is $2 million. So in this case, we get them to the highest income, assuming that's reasonable compensation of 305. They can do $27,000 on the deferral, 6% profit sharing, and then we've done prior service to get them $500,000 on the cash balance plan side. So a total contribution almost at 550 with tax savings at 40% of 219. So again, we were able to do higher compensation for the 35-year-old illustration, which allows them to get a little bit higher profit sharing. Deferral is still going to be higher over 50. And then we used a little trick that we used, which is prior service or past service, where we can give the attorney a credit for prior funding to the plan. That gets them this very large $502,000, which again works great for a current year when they've got such a high income. I did get a question here from George regarding profit sharing, only 6% of W-2. Traditional 401k profit sharing is 25% of compensation, okay? And so that would allow them, and typically a lot of these examples here, to get them a maximum profit sharing up to the cap of $64,000 for this year, 67, a little bit more for the 58-year-old. However, George, when you combine these amounts, when you combine these plans together, the IRS does not allow you to just layer retirement plan on top of retirement plan. In fact, there's a lot of different types of retirement structures, and some plans cannot even be combined together. In fact, a lot of SEPs cannot be combined. But the general rule is going to be when you have a profit sharing plan or a profit sharing plan tied to a W-2, the limit is 6% of W-2. So you actually lose contributions in these plans. For each of these examples, these people are going to lose, $20,000 to $30,000 or so on their 401k. But obviously, you can see they're picking up six figures. So that is important for you to note. There are a couple ways to get around that limit, but it's generally not practical to do. You can do a mega backdoor, you can do PBGC. There's a variety of criteria, but I would think for most people setting up these plans, you need to consider that 6% rule. Usually it's not a deal breaker because again, you can make so much more on these plans getting them in. So, that's why you can get the much larger contributions in, and something for you to consider. Why wouldn't any of these plans use a lower W-2 compensation? Well, in some situations you can get by, but generally these plans are age and income driven. So you want to see a rather high W-2. And I would tell you that with these plans, for example, if the business owner, the 65-year-old said, oh, I just want to pay myself $30,000 on a W-2 to lower their compensation, as a general rule, they wouldn't be able to get such large cash balance plan contributions. And the analogy I would like to use, if you've got an executive making 30 grand and you got if you've got an executive making 300 and you got a janitor making 30, the executive's going to get a much larger retirement plan contribution, right? I mean, they're an executive. They just deserve a very large amount, whereas the janitor's not going to get as much. Can you pay the janitor 30 grand but still get a lot more into retirement? Generally speaking, yes, but there are going to be limitations to that. And so as a general rule, it's not a big problem for most people because, George, you generally have to give something to get something. So if you really want to get 100 to 200,000 in, you generally need to put a little bit more into it. I'm going to move on, George, but I'm going to come back to your question on reasonable comp. I just want to make sure I get through the slides in case someone needs to leave right at the half-hour mark. reasonable comp is really a question for your CPA, but we'll talk a little bit about that as we move through. Okay, and I'll get back to it. Couple strategies we use to get numbers a little bit higher or more favorable include a spouse. If your spouse works in the business, consider paying yourself a higher wage. Again, that can typically allow you to get more in. We also can structure them to include 60% of employees. We have to provide a meaningful benefit to employees. We also can combine them with 401k and profit sharing plans. We also see clients that will hire just part-time employees or employees under the age of 21 so that they can keep them out of participating. We can use 3-year vesting. A lot of times people will use contract labor to get themselves out of these plans. Also, you can consider life insurance. There's different structures that can be done there. Section 199 QBID, there is a 20% business income exclusion deduction. So something for you guys to consider talking about it and with your CPA. Also, you want to determine if overfunding is an option, okay? So there's definitely some ways that you can do if your income, if your W-2 is a little bit lower and you want to get more in, or if you just had a great year, there are typically ways that we can structure them to get a much larger benefit. Obviously, that's something that we would do for you separately if we needed to. Deadlines for setup. Setup deadline is up to the date you file your tax returns, including extensions. So you actually do have plenty of time. Most people, though, try to get these plans set up with a December deadline. Main reason is you have to finalize W-2s. You can't overfund profit sharing plans. There's a variety of rules that you want to have in place going into the end of the year. So we recommend everybody try to have them set up by December 31st so you can coordinate all the moving pieces, but not necessarily always required. The contribution deadline, again, is up to the date you file your tax return, for the prior year, with the latest date being September 15th. So you've got a lot of time to fund the plan. You just have a lot of moving parts to get these plans set up, which is why we typically recommend December 31st kind of setup date. Special topic. I was just going to really define what a cash balance plan illustration is. I get a lot of clients that'll say, well, what is an illustration and what does it look like? It actually looks kind of similar. They come in different shapes and sizes, but an illustration will look very similar to that prior example. But it'll be specific to your situation. And I do see some people where they say, you can contribute up to a certain amount. Typically if a client says, I want to do 100 grand, we'll tailor the illustration a specific way for them. I'm not going to give you an illustration that shows 300 grand if you want to get 100,000 in. It's a waste of both of our time. So, as long as we get an idea on an illustration, what type of funding range you're looking for, then we can structure it and customize it. Most illustrations will combine a 401k and a profit sharing plan, so we can, make sure that, we're all on the same page. It's going to have a 6% limitation. We try to get restrictions in there, but the goal is to give you something that you can really share, an illustration that you can share with your financial advisor or your CPA, so you can have an intelligent discussion about these plans and how to structure them, for your business. So again, illustrations come in all different shapes and sizes, and sometimes we'll attach kind of a detailed review to these plans. But the reality is it's just something that will show you a funding level that's going to be customized to your liking. We obviously do free illustrations, and we'll talk a little bit about that here in a second. What do? Offer a turnkey solution. Again, we don't manage money. We set up your plans. We make sure that they're tax efficient. We do free illustrations for you. We do a free strategy review. We always recommend that people reach out to us for a consulting call to make sure we structure it. We do all your IRS filings for IRS and DOL. That includes your Form 5500, your Schedule SB, and all of your actuary reviews. Again, we do not manage money. That is generally up to you and or your financial advisor to take care of. And then lastly, Q&As. We're at about the 25-minute mark. Timing is pretty good. If you have any questions, feel free to email me, reach out to us. Certainly, if you've got some interest in a plan or an illustration, at the end of this, you're going to be redirected to our contact page. We encourage you to sign up either get a free illustration or sign up for a form, sign up for a call. That way we can really look closely at your situation and make sure that we structure a plan accordingly. So we highly recommend that you do that. You're certainly welcome to give us a ring if need be. So that's it. Again, I recommend everybody think about this. Consider if a plan makes sense for you. You will also get an email with a replay of this, so you can replay this webinar and again, digest it a little bit more to see if it makes sense. I'm going to answer. We've got a couple of questions here, but George, I'm going to answer a question. What is reasonable compensation per IRS? Reasonable compensation is what the IRS deems that you would need to pay someone to do your job. So essentially, George, if you said, I'm leaving the country, I'm going to be gone for a year traveling, I want to have someone come in and do what I do, whatever you would have to pay them is deemed reasonable comp. It is a subjective determination, usually made between you and your CPA. Nothing we really get involved in. Not our job to tell you what your reasonable comp is, albeit remembering that you typically want a higher compensation for these plans. Social Security does cap it at 147. So, once you go from 147 up to 305 or 200, it doesn't there's no big difference there from that. So again, something you want to review with your CPA. Steve has a question. We talked about money in. How does the client take it out and how does it get taxed? Money goes in and is invested rather conservatively, 5%. Client keeps it in the plan for however long they use it. They need it. Let's say you got a client who puts $100,000 in a year for 5 years, then they don't need the plan anymore. The plan's got $600,000 in it. They terminate the plan, they roll it over into an IRA, and then they just follow the RMD rules, or they take the money out, once they get to that point. Okay. So, at the end of the day, they can annuitize this, Steve. It can be done very similar to, it can be done very similar to a lot of other structures where, like, it's an annuity, right? Where you get a payment plan where you get, $3,000 a year, $4,000 a year for the lifespan. But that means that the plan has to stay open. And for a solo plan, that usually does not make any sense. Think of this as a big nest egg for a solo provider where they can get a chunk of money in and they can terminate it and roll it over into a plan. Another question here: does Empyrean have any marketing materials that could be private branded for my firm pitching CB plans to doctors, all other small business owners? We do have a few things. George, feel free to reach out to me and we can give you some information on how to do that. Typically, what makes a lot of sense is for you to get somewhat a little bit versed in the plans, and then we do run free illustrations. So we could run an illustration for you. If you've got a doctor, typically these plans are home runs for the right person. If you've got a physician making $500,000 a year, who makes, makes $500,000 a year, wants to get 100, 150 in, they're slam dunks typically. So we can definitely do consulting calls with you to help you out, but we do have some materials. Reach out to us and we can help you out with some of those types of things. Okay. Got another call here. A question: can a sole proprietor open a plan? Yes, I covered that early on. Sole proprietors can cover plans. Basically, anybody who's got employment taxes, anybody who's got anything subject to Social Security and Medicare, we could do. And so, if someone's got like rentals or something like that, it typically doesn't make a lot of sense. George has another question: is 5% target typical? Yes, very much typical. The IRS has a variety of different interest rates that you can use. There are variable rates tied to LIBOR and a variety of other things. As you're aware, interest rates have really gone haywire here lately. But generally speaking, a 5% rate, something in that range, is going to be very normal. And you want to keep these plans conservatively invested. I always tell clients, keep these plans very, very conservative. And I tell financial advisors, and to make up for the conservative nature, and you want them to be conservative, because if your plan grows, every dollar of asset returns is a dollar less that you can contribute and get the tax deduction. So keep these plans very conservative, but to offset it, put your 401ks, your IRAs, your other plans, make those very, very aggressive. If the client, Steve has a question, if the client puts money into life insurance, can they take it out as a loan? They can do loans with these plans, but there are some restrictions. The cash surrender of the life insurance works differently. So it doesn't work, one for one with people, but we do structure these plans with life insurance. And generally speaking, you can get half of them in. So if you've got a client situation where you've got a client who wants to put $100,000 in and take a tax deduction, he can typically do 50 grand in life insurance and 50 grand in what we call side fund. Not an insurance only DB plans. We don't do those. There are a few insurance providers, but we can split it out 50-50. And so we do have some life insurance providers that like to use these as structures like that. All right, we're just over the 30-minute mark. Any last questions? I think it looks like that's about it. We talked, I think there's another question I got on investments. Again, we don't give advisory, but yet you want to keep them more conservative. Again, feel free to get in touch with me if you've got any questions. I guess that's it. Hopefully we helped you out, gave you a little bit of insight into how these plans work. Feel free to contact us for an illustration or for any assistance you need with setting these things up. I hope this call was useful for everyone. And again, you're going to get an email with the replay. And let us know if there's anything we can do to help you out. Have a great rest of the evening, and hopefully we'll talk to some of you soon enough. Bye-bye.